In this video, Cathie Wood of ARK Invest has an urgent warning for stock investors. Cathie Wood has just uploaded a new blog post on the ARK Invest website discussing whether or not innovation stocks, ARK Invest bread and butter, are in a bubble or in deep value territory. Cathie Wood also shares decades of accumulated experience and wisdom investing in stocks, doing her best to warn investors from making the same mistakes she's seen play out decade after decade in the past. There's some extremely valuable psychological lessons here, and more important than that, Cathie Wood goes deep into the current state of the stock market, growth stocks, and what investors should and shouldn't be doing. Fair warning, Cathie Wood really gets down into the weeds in this blog post. I know some of you will be pumped about this level of detail, and others are going to have a whine in the corner. If you fall into the latter camp, it's too hard, Stephen. All I would like to say to you is good fucking luck ever making any decent returns investing over the long term, you filthy noob. So with that said, let's get into the video. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. Innovation stocks are not in a bubble. We believe they are in deep value territory. There is a ton of wisdom in this article, so I really do recommend you guys and girls stick around until the end. This is a masterclass in investing and psychology. Throughout my career, during times when disruptive innovation strategies have fallen out of favor, my primary concern has revolved around our clients, perhaps influenced by negative headlines in the media and by the inherent volatility of our strategy. Some clients have sold near the bottoms of market cycles, turning what otherwise would have been temporary losses into permanent losses. This is not only one of the dumbest mistakes investors make, but also one of the most common. For that reason, ARK places significant focus on our 5-year investment time horizon, communicating constantly with our clients via blogs, newsletters, media interviews, webinars, and other videos like our monthly In the Know series. You guys may have noticed me doing the same on this channel, constantly hammering home long-term investment horizon. I go so far as to abrasively and obnoxiously mock people who think they're investors for investing over short periods of time because they're not investing, they're gambling. Our primary message is that innovation solves problems and is expected to transform human lives at an accelerated rate during the next 5 to 10 years. Notice, we're talking about the next 5 to 10 years, not the next week, month, quarter, or even few years. This is what separates investors who actually make substantial returns over the long term from filthy, disgusting noobs. Short-sighted thinking, lack of conviction, not having a long-term thesis equals suboptimal results. We also reiterate that we take advantage of volatility during corrections and concentrate our portfolios toward our highest conviction stocks. The result of engaging with our clients has been asset retention better than many observers might have anticipated. Year to date, our inflows have outweighed our outflows significantly, suggesting that on balance, investors understand our active management investment process and long-term investment time horizon. Historically, and according to our research, this concentration of our portfolios during corrections has led to significant absolute performance and relative outperformance as the market rebounds. According to our current estimates, our more concentrated flagship strategy today could deliver a 40% compound annual rate of return during the next 5 years. Only one time in ARK's history, at the end of 2018, has the 5-year return projection been that high. If ARK Invest do see 40% compound annual rates of growth, we are talking about more than a 5x in value in just 5 years. $10,000 in, $50,000 in 5 years, $100,000, $500,000, etc. These are stunning, ridiculously obnoxious returns, especially given the fact that most investors are happy with 7 to 10% returns per year. After correcting for nearly 11 months, innovation stocks have entered into deep value territory, their valuations a fraction of peak levels. Many skeptics attributed our outsized returns last year to stay-at-home stocks and expected their fundamentals to deteriorate this year. For example, since its peak on October 19, 2020, Zoom's stock price has dropped roughly 68% to a level not seen since June 1st, 2020, as shown below. We'll get to below in a moment. Yet since its fiscal quarter ended July 2020, Zoom's revenue and EBITDA have increased 58% and 53% respectively. Can anyone smell that? Might be opportunity. Last quarter, on a year-over-year basis against a 367% gain during the depths of the crisis, Zoom's revenue increased 35% and its EBITDA 52%. In our view, the coronavirus crisis initiated a rip and replace cycle in the $1.5 trillion enterprise communication space, the first major product replacement cycle since the emergence of the internet roughly 30 years ago. We do not believe this shift was temporary. Stimulated by stay at home, this transformation has shifted to stay connected in a hybrid work world and stay competitive. And I think ARK have some valid points here. We are not going back, at least not entirely, to the way things were. This is a fascinating table to run through, exemplifying 3 of ARK's highest conviction names and what's happened to them recently. From peak to trough, Zoom down 68%, DocuSign 56%, and Teladoc down 70%. This is a fascinating comparison between revenue in their peak quarter in terms of the stock price and the most recent quarter. We can see enormous changes in revenue here. Zoom up 58%, DocuSign 59%, and Teladoc almost 200% increase in revenue. Yet the stock's down 70% over that same time. Something to think about. If you're a number nerd, feel free to pause the video, have a look at all these in detail, but I just wanted to illustrate the point. There's a massive disconnect here. The value of these stocks has fallen off the cliff, while the revenue has gone through the roof. Seems a little bit odd, doesn't it? Has inflation derailed disruptive innovation? Since mid-February 2020, many broad-based market indices have scaled to record highs and in the process, rotated away from growth stocks towards value. I like how ARK are using value in inverted commas. I'll talk a little bit more about this later. And defensive stocks, including the FANGs. Chief among the reasons for this rotation are fears. Notice the word fear, emotional rather than logical. Another point to pay attention to. Fears that inflation is not a short-term problem related to supply chain bottlenecks, but the result of excessive monetary and fiscal policy responses to the pandemic. Associated with strong economic cycles, inflation tends to benefit value stocks, particularly energy, financial services, industrials, and materials. At the same time, by raising discount rates and lowering the present value of future cash flows, higher interest rates tend to hurt long-duration assets like aggressive growth stocks. Typically, the companies underlying those stocks are sacrificing short-term profitability and investing aggressively to capitalize on substantial growth opportunities. Key example here, Tesla, 2019. Tesla can't make a profit. Tesla's going bankrupt. Next minute, Tesla starts printing money because Tesla had been investing aggressively in substantial future growth. That growth arrives, Tesla goes to the moon, does more than a 10x in about a 12-month period, and people are really surprised. ARK is suggesting that this same scenario is playing out across a broad number of growth stocks. In November 2021, Federal Reserve Chairman Jerome Powell suggested that inflation might not be transitory after all, turbocharging the rotation toward value stocks and giving investors more reason for tax loss selling in the innovation space as the year winds down. Are quant strategies and algorithms exacerbating inflation fears? As was the case during the depths of the pandemic last year, quant and algorithm-based strategies seemed to dominate stock market activity during the first 3 months of the rotation earlier this year and then again recently. By some estimates, algorithmic trading accounts for roughly 70% of all trading in the US, and even higher percentages during periods of heightened volatility. Last year, as the equity market responded to the ugly reality of the coronavirus during March and April, quant and algorithmically driven strategies seem to seize simplistically on 2 variables: level of cash on company balance sheets and rate of cash burn. And in just a few weeks, they crushed many stocks by 50 to 75%. Momentum followers and market commentators, aka sheep and clueless clowns, embraced this obvious trade, but they were wrong. Now, does anyone recall me posting videos on this channel during the height of the panic? Back in March, April, May of 2020? If you don't, I highly recommend going back and revisiting some of these videos. I did my absolute best to point out the insanity of the price declines in some of these stocks. One example in a video that I illustrated. Hey fuckfaces, you do realize that Tesla stock has dropped more than the airline stocks have at this point in time. Tesla's still making vehicles, and the airlines are currently grounded. Does this make sense to you? I don't think so. Has Tesla's production capacity been cut in half? No. Has their long-term growth over the next decade been slashed? No. Are people still going to want to buy electric vehicles? Yes. Are the costs of electric vehicles still coming down? Yes. Does Wright's law still apply? Yes. I think you guys get the point. So I can really relate to what Cathie Wood was talking about here. People lost their fucking minds back in early 2020. Well, most people did. And those who didn't absolutely cleaned up. Many of those stocks were in the genomic space. Their underlying technology is critical to tackling the very problem that was causing panic in the stock market. Genomic sequencing, synthetic biology, mRNA technology, machine learning, and molecular diagnostic testing, among others. Against conventional wisdom, buying those stocks was the right move. At times this year, as inflation and interest rates flared, quants and algorithms again seemed to dominate trading activity. This time, they seemed to seize on one variable: high valuations based on the short-term, keywords there, short-term earnings of stocks that benefited during the pandemic. Instead, they favored low multiple sectors like energy, a multi-trillion-dollar industry that everyone watching this channel will know is currently being enormously disrupted, and financial services, another gigantic industry also currently being completely upended. Investors have almost universally panicked their way into two industries that are being turned on their heads by disruptive innovation. This will not end well. Two groups that we believe will be disrupted dramatically. They're right. And respectively by autonomous electric transportation and digital wallets, decentralized finance, DeFi. Once again, market commentators, aka clueless clowns, investors, strategists, high-frequency traders and others follow the influencers, warning against mistakes made during the tech and telecom bubble. In our view, these Pavlovian responses, that may be the best thing Cathie's ever written. If you guys are unsure what the hell Cathie's talking about, Google Pavlov's dog. In our view, these Pavlovian responses will prove just as wrong as those in the early days of the crisis. They are backward looking, bingo, and don't recognize that companies investing aggressively today are sacrificing short-term profitability for an important reason. Something to think about. If you're an investor who can't see any further into the future than beyond the end of your micropenis, you're prone to making very poor decisions. This new age is thanks to the 5 major innovation platforms evolving today: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. Unlike companies paralyzed by short-term oriented shareholders demanding their profits and dividends now, truly innovative companies are on the offense. Investment paralysis, or benchmark sensitivity, seems rooted in the muscle memory developed during the tech and telecom bust and then again during the GFC, global financial crisis, in 2008 and 2009. Yet, if our research is correct, companies myopically focused on short-term profitability have not invested enough to capitalize on the explosive growth opportunities associated with the 5 innovation platforms that have been germinating since their seeds were planted in the 20 years that ended in the tech and telecom bubble. Instead, many are likely to suffer from creative destruction. Even the FANGs could be in harm's way as the convergence of blockchain technology and artificial intelligence in the so-called metaverse attempts to destroy the roles of centralized data aggregators, ceding economic power to creators and consumers. I'll shout out to people watching some guy on YouTube talk about the stock market rather than one of the Muppets on CNBS. Cathie has a point. The world is moving in this direction. Other markets are not corroborating fears of inflation. Perhaps oddly, we have been encouraged this year by talk of a bubble in the public equity markets as valuations associated with disruptive innovations have collapsed. Why? Because other markets are not corroborating the fear that inflation is here to stay. Broad-based public market indices, for example, are near record highs, their valuations at levels not seen since the tech and telecom bubble. In the early 80s, as inflation ravaged the US economy, the trailing 12-month price-earnings ratio of the S&P 500 collapsed to a low of 6.8%, roughly a quarter of the level in place today. Which market has it wrong? Stocks associated with disruptive innovation, or broad-based public equity indices? The latest example, Nubank, started this year with a funding round at a $25 billion valuation and went public this month 60% higher at more than $40 billion. Meanwhile, shares of Mercado Libre, aka the Amazon of South America, a well-managed competitive e-commerce and fintech stock growing at nearly the same rate, have been cut in half. Finally, the bond market seems to be warning the Fed not to tighten. Since February, the yield curve as measured by the difference between the yields on a 10-year Treasury bond and the 2-year Treasury note has flattened from 159 basis points to 80 basis points, pointing to the rising probability of recession, lower inflation, or both during the next year. In our view, the wall of worry built on the back of high multiple stocks bodes well for equities in the innovation space. The strongest bull markets do climb a wall of worry, a fact that those making comparisons to the tech and telecom bubbles seem to forget. No wall of worry existed or tested the equity market in 1999. For those of you not sure what Cathie's talking about, the 99 bubble, there was no worry. Everyone thought it was a free lunch. Buy this stock, make 4,000% in 2 seconds. Everybody's a winner. You can't possibly go wrong. Just invest everything. Stocks only go up. This time around, the wall of worry has scaled to enormous heights. And again, the use of the term worry, a very emotional response. Could the risk be deflation? I started my career while in college in the late 70s when inflation was soaring. At the time, most economists believed that inflation was transitory, except for Doctors Doom and Death, Henry Kaufman of Solomon Brothers, and Al Weinlower of First Boston, and Milton Friedman. Having witnessed that bifurcation, I am sensitized to the possibility that I could be wrong on inflation. That said, my conviction is growing that the biggest surprise to the markets will be price deflation, both cyclical and secular, and that, after collapsing this year, higher multiple stocks could turn around dramatically during the next year. Now, if you ask your girlfriend what she thinks about deflation, she's likely to respond that it makes her think there's something wrong with her. This is never she's talking about the different deflation, my bad guys. The secular case for good deflation is powerful. According to our research, which is centered around Wright's Law, 5 innovation platforms, the secular case for good deflation is powerful. According to our research, which is centered around Wright's Law, 5 innovation platforms will introduce deflationary forces that will build over time and impact every sector, industry, and company globally. Now, this is an extremely important point. It goes completely counter to the current narrative. A lot of people are super concerned about inflation. Inflation isn't transitory, blah, 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 blah. There's a lot of nuance to this topic. What ARK Invest are about to detail, sure, there may be some narrow inflation in certain domains, but overall, these disruptive, innovative technology platforms are going to cause widespread, good deflation across every aspect of the economy. According to Wright's Law, our research shows that costs associated with every cumulative doubling in the number of whole human genomes sequenced with long-read technologies will drop 28%, and those associated with short reads, 40%. Meanwhile, every cumulative doubling in the number of industrial robots and batteries produced will drive costs down 50% and 28% respectively. Does anybody know any companies out there that's planning on making robots or maybe batteries? I don't know, let me know in the comments below. Seems like there's a pretty fucking big opportunity there, just saying. Moreover, artificial intelligence training costs are declining at a rate of 60% per year. Does anyone know any companies that are developing artificial intelligence? I would love to invest in that company as well if they have a stock that's publicly traded. I just can't for the life of me think of any companies that are developing AI, that are planning to develop robots, or that have anything to do with batteries. Even better, does anybody know any companies that are doing 2 or maybe all 3 of these things at the same time? Boy oh boy, I'd love to invest in that stock. In fact, I might even go all in on that stock if only such a company existed. Provocatively, these platforms are converging, creating the potential for more dramatic cost declines as S-curves feed and reinforce one another. According to our current research, for example, the convergence between and among robotics, energy storage and artificial intelligence will create autonomous taxis and significant growth potential. By 2030, autonomous taxi networks could scale from no revenue today to $9 to $10 trillion globally, which when combined with the productivity uplift from time freed up behind the wheel, could total more than $20 trillion. That's trillion with a T. For perspective, US GDP today is worth roughly $21 trillion. In other words, good deflation could result in outsized growth rates for those companies positioned on the right side of change. Man, if only I could identify a company that was positioned on the right side of this change. Investing's hard. Subject to much more debate is the cyclical case for inflation. Supply chain bottlenecks that have lasted much longer than most of us expected have turbocharged the debate, especially now that the University of Michigan Consumer Sentiment Index has dropped to a level below that in the depths of the crisis. As stimulus payments bloated the savings rate to 33% in the spring of 2020, consumer spending on goods, which accounts for roughly 1/3 of total consumption in the US, soared, overwhelming businesses that had shut down. Prior to the pandemic, businesses already were in a risk-off mode, not only because of trade tensions between the US and China, but also because of an inversion of the yield curve in the late summer of 2019. As businesses were shutting down in early 2020, some consumers turned around and used government stimulus payments to hoard goods, boosting the level of inventories in their homes and garages. Exacerbating some supply chain issues, consumers started holiday shopping earlier this year out of fear that the shelves would be empty, pushing the CPI inflation rate to 6.8% in November 2021. At the same time, the US consumer savings rate dropped below 8%, the range in place before the crisis, leaving less room for future consumption and hoarding. This probably won't end well. As a result, consumption growth is likely to slow significantly in the next 3 to 6 months. By the way, someone set a reminder to check back in about 6, 7, 8 months time and let's see what happened. I suspect Cathie Wood and ARK Invest are going to be right. Let's keep them accountable. Just as supply chain bottlenecks are clearing, potentially saddling businesses with excess inventories. If we are correct, during the next 3 to 6 months, the market is likely to focus more on the risk of recession in the US, the serious slowdown in the Chinese and emerging market economies, and potentially a surprising drop in inflation. Some commodity prices already are flashing red. Iron prices have dropped 36%, perhaps in response to the real estate turmoil in China, while the Baltic Freight Dry Index has declined 39%, DRAM prices by 27%, and US lumber prices by 35%. Even the oil price, a notable outlier until recently, has declined by 15%. Typically, during a slowdown, the adoption of new technologies accelerates as concerned businesses and consumers are more willing to change behavior. Many of the technology leaders to which they turn now seem to be in deep value territory. Innovation stocks are not in a bubble. We believe they are in deep value territory. During the late 90s, equity investors ignored value stocks in favor of growth stocks, particularly those in the tech, telecom, and biotech spaces. The internet and its network effects seemed miraculous, enough so that investors chased the dream. Volatility on the upside was a beautiful thing. Unfortunately, too much capital chased too few opportunities, The technologies were prohibitively expensive and not ready for prime time. The cost to sequence the first whole human genome at that time, for example, was $2.7+ billion. And for context, today that same cost is less than 1 hour with your girlfriend. Tech and telecom companies like Cisco, Oracle, Hewlett-Packard, Intel, and WorldCom were not the companies that later would create the cloud, software as a service, or artificial intelligence chips. Yet, their stocks hit exorbitant valuations. Again, investors were chasing the dream. This is a perfect opportunity for a quick interlude to discuss, Rivian, Lucid, Nikola. I could keep going on. I mean, seriously guys, history definitely rhymes. What are the odds that in 20 years' time we're going to see company names like Rivian, Lucid, Fisker, General Motors, and Toyota? Just asking the question. Again, investors were chasing the dream, often with eyeballs as the only valuation metric. Value managers believed that valuing companies by the number of potential eyeballs they might serve globally in 10 years would not end well, and they were right. The day of reckoning took longer than expected, but on March 10, 2000, the bubble burst and value stocks took off. Ravaged by the tech and telecom bust in 2000 to 2003, and then again by the financial meltdown in 2008 to 2009, investors, especially institutional investors, are much more risk averse today. And this is understandable. Human beings, of course, are emotional creatures. You get burned a few times, have some extremely painful emotional experiences, you're likely to not only learn a few lessons along the way, but be permanently scarred for life and alter your behavior as a result. Now, in theory, as a human, this does have some utility. Thousands of years ago, you get mauled by a lion and realize, you know what, that was a fucking bad idea. The next time I see anything furry, I'm running the fuck away because I don't want that to happen again. However, when it comes to investing, a lot of people are now having these same emotional responses and not actually making sure, wait, is that a lion that's going to eat me? Or is that actually an opportunity that kind of looks like a lion but isn't? Personally, I think we're seeing a lot of stock investors have those same emotional responses. They got hurt pretty bad in 2000 or 2008, 2009. And so when they see something that kind of looks a little bit similar to that same event, their emotions take over. They can't see the forest for the trees and they assume it's another lion that's going to try and eat them for breakfast. And then they miss the opportunity. Volatility has become a bad word because every spike in the volatility index since 2000 has been associated with the bear market. Instead of surfacing and researching exciting investment opportunities in the burgeoning innovation space, investors seem to be hugging their benchmarks because they're scared and looking to the past for future success. Benchmarks guide investors to companies that already have enjoyed considerable success. And this is very true. By the way, many of these companies that have enjoyed considerable success in the past are currently being disrupted. Something to think about. Broad-based equity benchmarks could be in harm's way because of disruptive innovation. This may be the most important point in the entire article. Because the global economy is undergoing the largest technological transformation in history, most benchmarks could be in harm's way. Can someone let Graham Stephan know? Unlike many innovation-related stocks, equity benchmarks are selling at record high paces and near record high valuations, 26 times for the S&P 500 and 127 times for the Nasdaq on a trailing 12-month basis. Yet, the 5 major innovation platforms, which involve 14 technologies, are likely to transform the existing world order that the benchmarks represent, aka cataclysmic disruption just around the corner. Benchmarks, the old world, aka all of the indexes, are going to get completely fucked in the ass. Just saying. As a result, we believe tried and true investment strategies will disappoint during the next 5 to 10 years as DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology scale and converge. With a 5-year investment time horizon, our forecast for these platforms suggest our strategy today could deliver a 30 to 40% compound annual rate of return during the next 5 years. In other words, if our research is correct, and I believe that our research on innovation is the best in the financial world, it is, then our strategies will triple to quintuple in value over the next 5 years. Yet, as this year winds to a close, investors seem to be more interested in playing it safe, which I believe time will tell wasn't actually safe at all, but extremely risky, and moving closer to benchmarks that, in our view, are unlikely to generate even average returns during the next 10 years. Much like the early years of ARK's research on and investing in electric vehicles, Tesla, and Bitcoin, disruptive innovation seems to be in deep value territory. Remember when everyone laughed at ARK and then they went, oh shit, wait, they know what they're talking about, they made incredible amounts of money? And now everyone's laughing at ARK, people are saying Cathie Wood can't make money, don't buy the ARK funds. Cathie Wood suggesting here that the exact same cycle is about to repeat itself over the next 5+ years. And I believe she's right. Based on the last 8 years of our research, the opportunities will scale from $10 to $12 trillion today, or roughly 10% of the global public equity market cap, to 200 plus trillion in the next 10 years. We're looking at a potential 20x over the next decade. Not bad. And I have to say, I really wish investors would understand this. This is why I've taken the time to go through this article today. The reason that I continue to shout from the rooftops about what Cathie Wood and ARK Invest is saying is because they get it, they're right, and most investors can't see what's around the corner. We are at the precipice of an incredible, enormous, cataclysmic disruption. There's going to be huge winners and a hell of a lot of losers. Most investors think, oh, just buy the index fund. That's nice and safe. I'll get my 7, maybe 8 or 10% return every year. Allah, I'm super safe. I'm afraid not. We will not let benchmarks and tracking errors hold our strategies hostage to the existing world order. The coronavirus crisis permanently changed the way the world works, catapulting consumers and businesses into the digital age much faster and deeper than otherwise would have been the case. Dismissing innovation strategies that stay at home glosses over a crucial point. Innovation solves problems in a way that consumers and businesses adopt with relief, enthusiasm, and delight. Critical to investment success will be moving to the right side of change, avoiding industries and companies caught in the crosshairs of creative destruction, and embracing those on the leading edge of disruptive innovation. Bravo, bravo, Cathie Wood. Round of applause. Hit the nail on the head. This is such an incredibly important message from Cathie Wood and ARK Invest. The vast majority of stock investors out there in the marketplace today have no idea what's coming. Safe, conservative investment portfolios, index-style investors who just buy ETFs, buy the S&P 500, buy this index, buy that index, are going to get completely fucking eviscerated. We have never before seen a convergence of so many disruptive technologies at the same time. As Cathie Wood pointed out in these articles, we're going to see S-curves feeding S-curves. What used to work in the past, what seemed safe and conservative, is now going to be an extremely high-risk investment strategy. This is such an important issue that I'm going to keep banging the drum on this and trying to warn as many investors as I possibly can. By the time people realize what's going on, it's going to be too late. Let me know what you guys and girls think in the comments below. Is Cathie Wood right? Are we likely to see good deflation occurring in the future because of all of this disruptive innovation? Do you also believe that the old world is going to be completely disrupted and that innovative stocks are now in deep value territory? And don't forget, if you'd like exclusive access to my Tesla stock price targets over the next 10 years, over 100 exclusive Q&A videos, and a ton of exclusive content and perks, head over to Patreon with the card in the corner or the link in the pinned comment, and I'll see you guys in the next video. I'm Stephen Mike Ryan, this is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.